What is going on? Welcome back to the channel. So today when I talk to you about Disney, just unveiled their earnings. I want to break it down on some of the key data points that you need to know, as well as the key highlights that investors need to be and take away from their recent earnings. So I'm going to go over all that. Make sure you guys hit that thumbs up. And with that, let's get right to it. So Disney is down 1.36%. It did have a low today so far of $110.78. So give yourself a shout out if you did catch the bottom, or if you bought, sold, or whatever else. As far as some key data points that you need to be aware of, shorts are returning 422,000 shares. I like to analyze this type of information because it goes to show like what the true counterparties are feeling. So 1.1% of the free floats being shorted works out to be 19.89 million shares. Shorts have been increasing leading up to their earnings. So I think they did kind of anticipate maybe a miss or potentially bad future guidance or something along those lines. But yeah, they definitely have been increasing. Nothing significant once again because Disney's not a squeeze play, but still good to and very important to analyze this type of information. Short value. So right now there's $2.3 billion worth of shorts out there. So definitely something to keep in mind. 22 million in calls, 6.05 million in puts. 50% of all the options being done today are bearish in nature. This one right here, so between 1235 and 1240, there was 509,000 in premiums. So that one definitely is a very big outlier. And if we kind of look at this, sort it based on the premiums, so it looks like it was, for the most part, one large transaction, which was generally bearish. Looks like a $114 call was sold. So in case you guys don't know options, that's kind of meaning that for the next little bit. So it looks like from now until February the 14th, so that's the expiry date, 9 days away, there is a good consensus for it to be sub 114. So again, there's that and quite a few other ones as well. So it looks like it was more of a multi-leg transaction, so kind of some bullish, some bearishness, but the main part of it, $260,000 worth, was 114 for that. Of the call options that are being purchased, you see a consensus for it to be above 120, so good amount of optimism for that for the foreseeable future. Bears, though, on the flip side, they're anticipating for it to be sub 110. So again, that's something to keep in mind. Big money definitely is paying attention to Disney today. So these are all the transactions occurring on the secondary market above $100,000. 1.6 million, 1.09. Quite a lot as far as that. With it at 111 and change, it is exactly on this S1. So watch for it to close above $111.81. Aside from that, 113 will be the next strong target / resistance, then 110 and then 109 will be the next strong support level. So kind of just follow that and take note of those. Aside from that, these are all kind of the recent ratings. Only one came in, and it looks like it's so far, or actually I guess there has been no ratings coming in so far from their earnings that was this morning. So you had one that was done yesterday, and I've never really understood analysts giving ratings the day before, or even the weeks leading up to any company's earnings. It just doesn't logically make sense. So you have a $120 buy that was done yesterday, analyst who has a 74% success rating. Aside from that, 125, 128 as a consensus of all of them, though, $126.81, and that does represent a 13.4% upside. So stay tuned for more ratings. If you do want a follow-up video, I can definitely do that. Go over some of the data points at that time and recent ratings. But some key and absolute takeaways from their earnings that you need to be aware of. I'm going to play this, so let me know your viewpoint on these and if there's any good takeaways from their earnings that you generally liked. So again, let me know your thoughts. Don't forget to hit that thumbs up. And with all that, let's get right to it.
Disney outlines growth in streaming profitability and plans ESPN flagship launch for fall 2025. Earnings Call Insights, the Walt Disney Company, DIS, Q1 2025 Management View. CEO Bob Iger highlighted the company's strong performance in Q1, driven by top box office results, increased streaming profitability, and historic ratings at ESPN. He described the quarter as reflective of Disney's creative and financial strength, with significant gains in the experiences business. Iger announced the rollout of several technological advancements for Disney Plus, including enhancements in personalization and the integration of ESPN's flagship streaming service, set to launch in fall 2025. CFO Hugh Johnston reiterated confidence in the experiences segment, maintaining guidance of a 6%, 8% increase for the year. He noted strong early performance in Q1 and expected further momentum from new offerings such as the Disney Treasure Cruise ship and expanded Lightning Lane access. Johnston also emphasized ongoing cost-cutting measures and efficient expense management while maintaining investment in growth areas. Outlook. Management reaffirmed its guidance for high single-digit earnings growth in fiscal 2025 and low double-digit growth in fiscal 2026 and 2027. This is supported by significant improvements in Disney's direct-to-consumer (DTC) business and continued expansion in experiences. Disney remains bullish on subscriber growth for Disney Plus and Hulu, driven by paid sharing initiatives, personalized recommendations, and a robust content pipeline. Management also anticipates a boost in DTC profitability, targeting over $1 billion in operating income for fiscal 2025. The planned ESPN flagship streaming service is expected to further enhance the company's sports offering by providing a more personalized and comprehensive experience, including the integration of betting and fantasy sports features. Financial results. Adjusted EPS for Q1 2025 was $1.43, in line with analysts' estimates. Revenue for the quarter was approximately $24.55 billion, also matching analysts' expectations. The experiences segment showed strong growth, supported by the successful launch of the Disney Treasure Cruise ship. Johnston noted that the segment's performance exceeded internal expectations for the quarter. Streaming profitability improved year over year, with Disney Plus and Hulu contributing positively to the DTC segment's operating income. Cost-cutting efforts included a reduction in the content budget to $23 billion, down from $24 billion, while maintaining a focus on core creative priorities. Q&A. Ben Swinburne, Morgan Stanley, asked about platform enhancements for Disney Plus and the outlook for the experiences segment. CEO Iger explained that technological upgrades, including anti-password sharing measures and algorithm improvements, are already underway, with significant progress expected by year-end. Johnston reaffirmed the experience's guidance and highlighted strong early bookings for the Disney Treasure. Robert Fishman, MoffettNathanson, inquired about ESPN flagship's impact on the sports business. Iger described the service as a transformative product aimed at growth, offering enhanced features such as tailored content and betting integration. Jessica Reif Ehrlich, Bank of America, raised questions about the NBA contract and its profitability. Johnston stated that the financial implications were fully accounted for in guidance and emphasized confidence in the long-term value of the NBA as part of ESPN's portfolio. Sentiment analysis. Analysts expressed cautious optimism, focusing on Disney's ability to deliver on ambitious DTC and experiences growth targets. Concerns centered on challenges in managing linear network declines and integrating new streaming initiatives. Management maintained a confident tone throughout the call, emphasizing progress in strategic priorities and readiness to adapt to market dynamics. CEO Iger frequently highlighted the company's creative strengths and technological advancements as competitive differentiators. Compared to the previous quarter, management's tone reflected greater confidence in achieving financial and operational goals, particularly in DTC profitability and experiences growth. Quarter-over-quarter comparison. Management's tone this quarter was more optimistic, driven by strong early results in the experiences business and improved streaming profitability. In Q4 2024, the focus was on setting the groundwork for fiscal 2025. This quarter emphasized execution and early successes. Analysts shifted their focus from broader strategic pivots in Q4 2024 to more granular questions about specific initiatives such as ESPN flagship and international content strategy. While guidance remained consistent, management indicated stronger confidence in achieving previously outlined targets, citing progress in reducing churn and enhancing engagement across platforms. Risks and concerns. Management acknowledged ongoing challenges in the linear network business but emphasized the strategic shift towards streaming. The potential impact of competitive streaming platforms was noted, particularly in international markets. Analyst concerns included the profitability of new content investments and the ability to sustain growth amid macroeconomic pressures. Management highlighted cost discipline and technological advancements as key mitigation strategies. Final takeaway: Disney delivered a strong start to fiscal 2025, with significant progress in streaming profitability, top performing box office releases, and robust growth in its experiences segment. The company remains focused on technological enhancements and new offerings, such as the ESPN flagship streaming service, to drive future growth. Management's reaffirmed guidance and increased confidence reflect its strategic execution and ability to adapt to changing market conditions.